Hey everyone, I'm Doug the Retirement Guy with all your monthly ETFs. Today we have a deep dive we're going to compare two popular covered ETFs, the JEPI and the SPYI, to better understand how their strategies, their income characteristics, and the historical performance differ based on available data that we are available to obtain. So we want to do how to maximize dividend income in a changing marketplace. Before we do, I got to put a shout out to all of our Patreon supporters and all our YouTube members. Thank you for sponsoring and supporting the channel. Also, all of our YouTube subscribers. If you're not a subscriber to the channel, don't be afraid. Hit that subscribe button, hit that bell notification. We'd love to have you part of the family. Let's get into today's video. Notice to all viewers, past performance does not guarantee future results. This information is provided in the video is for educational and informational purposes only. It is a snapshot of what's going on in the market as of today. This is not to be considered financial advice. If you need financial advice, always contact a financial advisor. So the covered call ETFs market overview. Covered call ETFs continue to gain significant traction among high yield investors in 2025. The total net assets have reached an all-time high. Now, JEPI is the largest assets ETF. The JPMorgan Equity Premium Income ETF, JEPI, leads with over $41+ billion in assets under management. It's an established leader. It's existed for over 5 years, building a track record in various market conditions. Now, emerging players, the NEOS S&P 500 High Income ETF, SPYI, is a newer track that has seen increasing investor interest. When we look at what's going on, look at the numbers, 41 billion in JEPI. And when you look at covered call ETFs as a whole, a little over $20 billion. So a big difference in marketplaces. So this is why we're going to do the challenge between JEPI versus SPYI. So understanding the investment strategies first, JPEI uses an active management. It actively seeks the selection from the S&P 500 based on attractive criteria. The continuous rotation of holdings as stocks no longer fit the criteria, and uses equity-linked notes, ELNs, to generate their income. It collects option premiums while maintaining lower volatility stock portfolio. It aims to provide index-level option premiums with active equity management. Now, SPYI is a passive approach. It holds all the 500 of the S&P 500 in a fully tracked broader market performance. It's a passive underlying equity portfolio with active options overlaying management. Optimistic call option selling on the S&P 500 SPX and maintains a broader market exposure while generating income through options. So you can see they have two different strategies and two different ways of doing it. The dual approach allows for market exposure and income generation through those option strategies. So SPYI is using some new ways of doing things. JEPI is using the old way of doing things to give us two different approaches. So the total return performance comparison during the review period, SPYI showed a higher return rate than JEPI, despite JPI's active manage approach. So the S&P 500 hit 14.43 in 1 year total performance during our review period. SPYI hit 13.51% total return, while JEPI only hit 3.96%. So the SPYI strategy of tracking the entire S&P 500 provided exposure to the mega cap stocks that drove the market returns, while JPI's active management seemingly missed out on those outperforming companies. Now, when we take a look at the distribution yield, for income invested focused investors, distribution yield is critical metric when calculating out covered call ETFs. So during the period that we evaluated, the income generation, SPYI had a trailing 12-month yield of 11.62% compared to JPI's 7.51. Now that's a considerable gap. This represents a 4.11% advantage for SPYI, providing potential more income. And the investor impact is for income-focused investors. This means potential more income. And then when we take a look at the distribution stability, SPYI stability distribution, essentially there was no large month-to-month changes. So that we had that potential of consistent income for budgeting. And then when JPI, during that same exact period that we reviewed, we showed a 20% plus monthly declines in the distribution, giving us a little more of an unpredictable income stream. So the SPYI strategy of tracking the entire S&P 500 displayed less month-to-month variations of distributions during the reviewed period, while JPI's active management has led to significant volatility in the payouts. Now, looking at the tax implementation breakdowns, I will tell you right up front, I always say this, always contact a tax professional. I personally have a CPA that I could text, call, email anytime I want. But the situation is this: you need to understand the tax implications, breakdowns, and I highly recommend you talk to a tax financial first or a professional financial advisor. Because JEPI and SPYI distributions may be treated differently for tax purposes due to their underlying structures. JPI distributes are generally taxed at ordinary income due to its use of the equity-linked notes. Now, SPYI distributions may include return of capital and other classifications depending on the period. Tax treatment varies by individual circumstances and account types and holding periods. Investors should consult a qualified tax professional before ever investing into the funds. Because with SPYI using that Section 1256 income and a return of capital, JEPI with the ordinary income, this is a very high-tech things for taxes, and it's an important piece of the structure. So we take a look at JEPI's competitive edge, the lower expense ratio, the brand recognition with over $41 billion in assets, and proven market conditions over multiple market cycles. You got to give a hands up to JPIs because they've existed for over 5 years with a built-in track record, while SPYI's newer ETF has less historical performance. Both have different investment approaches. So the risks and considerations, SPYI has some key uncertainties. What happens to SPYI in market downturn performance? Is it going to continue to perform the big numbers? The payout stability in a recession. And the mega cap leaders, as the strategy behaves when mega caps don't lead the market. So there are some questionable things. While JPI's advantages are it's a lower expense ratio, brand recognition, and it's been market tested in bear and bull markets. So there is a difference between SPYI and JPI. And so it's kind of like, do different paths to go down. So the key educational takeaways, here's what I give you as the key educational takeaways in this comparison. JEPI and SPYI use different option income structures. Active versus index-based equity exposure leads to different outcomes. Distribution levels and stability vary by strategy. Tax treatments all depends on the structure and individual circumstances. Market conditions play a significant role in the outcome. So in this video, there is no select winner. It's about understanding how the different covered call strategies behave. So you take your risk considerations, which are unknown performance in down markets and drawdowns, uncertainty about maintaining stability payouts during recessions, and the performance when mid caps don't lead the market. So JEP still has an advantage. With its lower expense ratios, JPI has more of a brand recognition, and consider both ETFs for a balanced approach. I personally, in my portfolio, own both of them. I love how they work together. I love the balanced approach that they do. So I really don't believe that there's a winner either way, and that's what we weren't trying to do. We were trying to explain to you the total between the two. Tell me what you think. Which one? Do you like these working together? Do you like them individually? Tell me about your input. Love to hear your comments down below.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments